Assalamualaikum. Today we'll be starting on a new chapter. Okay, the title is Business Combinations and Introduction to Consolidated Financial Statements, which is also called as CFS. Okay, so first you got to know what is business combinations. So business combinations by the means of combinations, meaning combining of two entities into one. Okay, so business combinations may arise when one entity acquires control over another entity. Okay, so the business combination can arise in two methods, by two ways of doing it. So usually business combination is also known as acquisition, because you acquire A company acquired B company. So how is this done? Okay, there are two methods of doing it. First, purchase of assets. Okay, you can buy the assets of this other company. So let's say A wants to take over B. So they said, okay, I will purchase all the assets of B company. So when they acquire assets, they also have to take over the liabilities. Okay, this can also be known as amalgamation or absorption. So these are two almost similar but slightly different. Okay, so we will discuss this later. So another method is by acquiring control. Acquiring control is, instead of you purchasing the net assets and taking over their liabilities, you purchase the share capital. Okay, A wants to take over B, so A decides to purchase certain portion of shares in B. So if A took over majority shares in B, then A will become a parent company and B will become a subsidiary. So we will continue this later. Okay, a parent and subsidiary. Okay, when an entity acquires control over another entity, okay, the entity that controls is called the holding or parent entity, and the entity being controlled is called the subsidiary. Okay, so together they form a group, though both the entities remain separate physically and legally. Okay, so in other words, okay, A is a company called A Sdn Bhd. B is also a company, B Sdn Bhd. But when A takes over B, okay, A becomes the parent because they hold the major shares in B. So A becomes a parent or holding company, and B becomes the subsidiary of A. Okay, to understand better, okay, let's look at this diagram. Okay, H is called the holding or the parent company. Okay, and then H has a few subsidiaries. Okay, you have S1, subsidiary 1, where H holds 55%. So H holds 55% and the balance of 45% is being held by S. So S becomes the subsidiary holding 45% shares. Okay, S2. Okay, S2. Okay, H holds 100% shares in S2. Therefore, this is a wholly owned subsidiary. Okay, so wholly owned subsidiary. So meaning the subsidiary itself doesn't have any shares. All of the shares is being held by the parent company. Okay, and S3. Okay, S3 holds 75% shares, and the balance 25% shares is being held by the subsidiary. Okay, and next, 68% hold by holding, and 32% is held by subsidiary, and 85% held by holding and 15% held by subsidiary. Okay, in this case, H holds majority shares in each of these company, so therefore they becomes a holding of the parent company, and the balance shares held by subsidiaries will become minority interest or non-controlling interest. Okay, this you will hear about it much more soon. Okay, there is another situation which is called reverse acquisition. So previously, the one that we have here previously is A taking over B. So A becomes the majority shareholder of B. But now we will learn more about reverse acquisition. So A takes over B. Instead of A being the majority shareholder, now B becomes the majority shareholder and B becomes the holding company instead of A. So let's look at this example. Okay, H has in issue 2 million RM1 ringgit, RM1 ordinary shares and reserve of RM5 million. So H has ordinary shares of 2 million and has a reserve of 5 million. So S has 4 million shares of RM1 each and 10 million in reserve. Okay, so now H issues 2 ordinary shares in H for every share in S. So H acquires all the shares of S. So in other words, H gives to S 2 shares for every 1. Okay, 2 shares in H for every 1 shares in S. Okay, so H acquires all the shares in S. So S has 4 million shares. So if H wants to take over all 4 million, so for each 1 shares, H has to give 2 shares. Therefore, 4 million. So H has to give 4 times 2, 8 million shares to S. Okay. So H will issue 4 million times 2, that means 8 million shares. So the enlarged share capital of H will be, so previously they only have 2 million, now they have plus 2 plus 8, therefore giving they have a total shares of 10 million shares. Okay, of the 10 million shares, the former shareholders of S, remember S now holds 8 million shares in H. 8 million out of 10. Therefore, the original shareholders of H only holds 20%. How is that? Because H only holds now 2 million shares out of 10. So that means now H only holds 20% interest in his own company, whereas S is holding 80% interest in H. So now S is in substance the parent, though legally a subsidiary. So this is called a reverse acquisition. Okay, earlier I mentioned non-controlling interest or minority interest. Okay, subsidiary is also known as non-controlling interest, or usually you use it as a short form NCI, or in books the previous edition it is called minority interest MI. So in other words, for subsidiary is NCI or MI. Under the Companies Act 1965 and the FRS Financial Reporting Standards, okay, it is stated that the holding company or the parent company needs to prepare the consolidated financial statements. Okay, but there are exemptions to this. Okay, the exemptions that we would focus on will be one, wholly owned subsidiary. Okay, wholly owned subsidiary. Okay, you can go back to the previous slide where H holds 100% shares in S. So if H, the holding company, holds 100% shares of S, therefore S become a wholly owned subsidiary of H. So in this case, H is exempted from doing the consolidated financial statement. Okay, because S is wholly owned, so it becomes the accounts of H will already comprises of the accounts of S because H holds 100%. Okay, and then the second is parent company is not a listed entity. Okay, usually if you are not listed, that means you are not you do not have shares on the KLSE, the Kuala Lumpur Stock Exchange, so you are not issuing shares to the public, so you need not prepare the CFS, because usually CFS is prepared because we are have to give to the public in order for them to participate in acquiring shares in our company. So these are the two exemptions that we would usually be focusing on. Okay, let's focus on this diagram. Okay, so H in this diagram, first diagram, okay, H is the ultimate parent. Okay, S is the intermediate parent because they have another subsidiary down here. Okay, but in this case, H holds 100% of S, therefore S is a wholly owned subsidiary of H. So S accounts will be already included in H. So in this case, S need not do the CFS. Okay, so S need not do the CFS. Okay, now in this case, H holds only 60% of S, whereas 40% is owned by S itself. So S now has another subsidiary which it holds 90%. So that means they have another 10% which is held by the SS, the NCI or the MI. So in this case, S has to do a CFS. S has to prepare the consolidated financial statement comprising of its accounts and also the accounts of its subsidiary. Okay, so how to prepare the financial statement we will learn later.